Good afternoon, everybody, and welcome to our webinar today, hosted by Capstone Financial Management. The title being Tax Year End, Use It or Lose It. So, hosting the webinar today, we have myself, Liam White, and my colleague, Richard Goodier. Richard will be speaking around the various allowances that we have throughout the course of the tax year and how they can be used. Personally, I'll be then covering some interesting slides regarding potentially investing in uncertain times, how we manage those investments, and essentially how we reduce risk within investing as well. So, what will we be talking about? There are various allowances that we have, legitimate tax planning allowances that are completely legal, and this is what we are trying to encourage our clients to do. We're here to try and help save you as much tax as possible in the best way. What we're not looking to do is trying to introduce tax schemes that might be somewhat not within the spirit of the revenue. So we've got certain allowances such as ISAs, pensions. These are legitimate ways of avoiding tax. Many of the allowances that we have really are available for the current tax year. So the current tax year will be coming to an end on the 5th of April. So we've got allowances that some mostly will be available for this year, and then they will be lost if they're not used. Some allowances that Richard will cover can actually be recovered, and we can actually look to carry forward previous allowances. So when we're looking at tax efficient investing, coming up towards the end of the tax year, there are 4 key pillars that we like to talk about. Each of these has different tax reliefs available, both on how the tax relief is achieved on the way into the investment, and also how the income or any gains from the investment is taxed on the outset. So today we'll actually be covering, in the main, ISAs and pensions. We've also got investments called venture capital trust investments or enterprise investment schemes, which are a little bit more complex, and it is best covered on a separate topic. But please do sort of leave any questions towards the end of the seminar, and we'll pick those up at the end. I must make a point as well. There is a chat box on the seminar, so please do put your questions down, type them in, and then we'll pick those up at the end. So in summary, we have ISAs. So there's a £20,000 allowance that we all have before the end of the tax year that can be invested. There's no tax relief to put money into an ISA. However, they will grow free of taxes, and there's no tax issues when you actually come to encash the ISA at the end. We also have pensions allowances. So the annual allowance for pensions currently is £40,000. You do get tax reliefs by putting money into pension. How that tax relief is received depends on the type of contribution. When you come to withdraw money from a pension, the benefits can be taxable, aside from the tax-free cash that we can take out. Venture capital trusts, I won't go into the details of the tax relief. However, we do have an allowance to put into venture capital trust investments each year, which is currently £200,000. Enterprise investment schemes, we actually can put up to £2 million into an enterprise investment scheme, and the tax reliefs are quite significant. So, like I said, it's best to pick these up at a separate event, because everybody's tax situation will be completely different. So, for the next series of slides, I'm going to hand over to my colleague Richard Goodier, who will talk a little bit more in depth about the different allowances that we have.
Thank you, Liam, and a very warm welcome to everybody on the call from me. So, Pillar 1, ISAs. Now, I'd be very surprised if there's too many people on the webinar who haven't actually heard of ISAs. And they were introduced first in 1999. Over 22 million adults have them. The total investment in there is over £600 billion now. So I think it's fair to say that they've been a very successful way for people to shield their money from taxes. And an ISA is exactly that. It's not the actual saving or investment. An ISA is a tax shield or a tax wrapper. And it shields your hard-earned cash from income tax and also from capital gains tax. Now, very nearly half of the total amount that are in ISAs are in a cash ISA, which essentially is a savings account. There are also investment ISAs, which we'll come on to explain in a few moments. Now, there have been some movements in both interest rates and returns and also tax legislation, which is starting to question whether a cash ISA is actually the right place to hold your cash that you may need to access. And everybody has to or should have access to a certain amount of cash in case, say, the boiler breaks down or something like that. However, with interest rates being very, very low since the credit crunch in 2008, it's rare for a cash ISA to actually have a return that comes anywhere near to inflation. And we can also see that the banks and billing societies that market these accounts, the cash ISAs seem to have gone a little bit further off their radar. And you can see on the screen now that actually just in normal savings accounts, the return is actually higher than in cash ISAs. So when you're looking at the place to hold your cash that you might need to access in an emergency, actually have a look at the normal savings accounts as opposed to cash ISAs, because it might actually be paying a better rate. Now, some of you might say, well, actually, I'm going to get taxed on the non-ISA part. But actually, if you look at the tax legislation from a few years ago, April 2016, there was a new saving allowance called the personal savings allowance, which abolished tax on savings for the majority of savers. So you might notice now that when you get your bank statements, that the interest that is added on does not have tax deducted from them, and that's because of this new allowance. So for a basic rate taxpayer, you can receive £1,000 of interest without actually having to pay tax at all. To put it another way, that's £76,000, nearly £77,000 in an easy access Best Buy savings account that you could hold without actually paying any tax on that interest. For a high rate taxpayer, it's £500, so obviously that figure halves. If you're an additional taxpayer, then you don't actually receive this allowance. But for basic and higher rate taxpayers, you'd have to question why you might be using a cash ISA rather than an investment ISA because of these changes. So, one of the other types of ISAs that you can use is investment ISA. Now, if we look at what you could have done with that, say, over the last 10 years, on the screen now you can see various types of equity indices from around the world, the FTSE 100 obviously being the UK one on the left-hand side. So you can see that if you had invested £10,000 10 years ago, the majority of those is over £20,000. And that also does include the 2018 performance, which some of you who follow markets might know that Q4 last year was actually quite negative territory for most markets around the world. And you can see that on the bottom of the screen towards the right-hand side. But even so, even after having included that downturn, you can see the returns are very healthy and by far and away in excess of anything that you get on a cash ISA. So if you already hold investment ISAs, these are some of the things that we would actually recommend at Capstone you should be looking at, as well as looking to use your this year's actual allowance of £20,000. So for example, we would urge you all to have a look at how your investment is actually performing. For a lot of our clients that we've seen in GUNNERCOOKE, we've actually had a look at how they've been performing, and we can analyse that for you. It might well be that when you chose your investment, you might have followed a particular fund manager. But do you know, are they still in that team? Are they actually still managing your money? Because they do change. Does the spread of investments still match your attitude to risk? So, for example, if you have a certain element of your investments which has actually done really, really well, say, for example, US shares, then it could well be now that you're actually quite exposed to US shares because of that growth. So you might actually want to have a look at rebalancing that portfolio so that you're now taking the risk that you're more comfortable with and not too exposed to a different market. Does the portfolio still meet your objectives? So, for example, many GUNNERCOOKE clients that we've seen are looking to use ISAs to actually income generate in the future. If that's the plan, does your portfolio is set up to meet that objective? Because an income generating portfolio usually is quite different to one that we use for growth. Now, we shouldn't forget about the little people, so junior ISAs. Now, £20,000 is the limit that we can put in for anybody over the age of 18, but you can also, for children, you can actually put up to £4,260 into an ISA for a child. Now, the parent or guardian must apply, but actually it's anyone that can contribute. So, for example, grandparents, we come across grandparents who perhaps have just had the state pension that has come in, and they're looking to gift money down the generations. They could put that into here, and not only would it go into a tax-free fund for their grandchild, but also it would be free of inheritance tax immediately because it's gifting out of income. So anybody can contribute to this. It's something that I've used myself. I have two children just at university, and this is now being used to help fund them through those years, which can be quite expensive, as some of you on the call may know. So, some key points to consider to summarise for ISAs. Each individual can invest up to £20,000 for this year, and at the moment, obviously we could do 20,000 this year. Come the 6th of April, you can do a further £20,000. So again, something to consider to get that money in at the start of the tax year, not just at the end. The returns from ISAs are completely free of income tax and capital gains tax. So they are really, really good at shielding your hard-earned money from HMRC. On death, not so much nice to talk about, but ISAs, the tax-free nature of ISAs are transferable to surviving spouse or civil partner on death. So on that first death of a couple, the ISA is not, the tax-free element of the ISA is not lost at all. And finally, the junior ISA, as we've talked about, 4,260 this year is available for those under the age of 18. Next year, our allowances for adults is 20,000. The junior one actually does increase with inflation, so that does rise slightly each year. So, moving on, one of the fantastic ways you can shield your money from the HMRC is actually into a pension. Now, there are some similarities with ISAs with pensions. So, for example, once the money is actually invested, it does shield it in the same way as an ISA from income tax and also from capital gains tax. But the differences, as Liam alluded to earlier, are in the way that tax is treated for the contributions and also in the way that tax is treated when you start taking money out of your pension. So we're going to just go through a few different ways which you can use pensions in order to access this very, very significant tax relief and also tax-free from an inheritance tax point of view, which is coming more to the fore, certainly with our conversations with GUNNERCOOKE partners. So, first of all, tax relief on contributions. Now, I'm conscious that a lot of people on the webinar will actually run their business through a limited company. What you see on the screen is actually how tax relief would be used for personal contributions. And quite a common question we get asked from GUNNERCOOKE partners is, well, should I be funding my pension personally, or should I be funding my pension through my company? And in the main, we would normally guide a client down the route of funding it from their company. But there are certain nuances with that, and it does depend on the individual situation. So that is, if that's a question, then certainly we'd probably better have a face-to-face meeting on a one-to-one basis. It's not really something to talk about in this sort of environment. But you can see that for personal contributions, depending on whether you are basic, higher or a top rate taxpayer, the government is actually funding that. The way it works for a company contribution is that you don't obviously need to take the money out of the company, so you're not paying dividend tax on it. It goes straight into the pension from your company. The contribution appears on your profit and loss account as a trading expense, and therefore it reduces your corporation tax bill. Currently, that's obviously the figure at 19%. Now, Liam also alluded to earlier that actually you can use up this year's allowance, which is £40,000, subject to the level of earnings, which we'll come on to in a second. But you can also backdate through to the previous 3 tax years. So if you cast your eye down to the Blockbusters screen from sort of Bob Holness from a few years ago, the Gold to Gold run, then you can see that you can use up the 2018-19 tax year, the 4th block along, which is for 40,000. But you can also use up the 2015-16 and the next 2 tax years to add up to £160,000 maximum. Now, obviously, if you have contributed to a pension during that time, that would reduce those numbers. But it's certainly a calculation that we'd only be happy to do for you at Capstone because the tax penalties for going above these numbers are very severe indeed, and we wouldn't want any GUNNERCOOKE partners walking into or sleepwalking into a huge tax bill which they weren't expecting by making a contribution above those numbers. Now, quite a busy screen this one, but essentially we just want to let people know that depending on your level of earnings, if that is above £150,000, and these are personal earnings, then you may actually, well, you will have a reduction in those £40,000 across those 4 tax years which you see on the screen. So if you, for example, I'll just pick the £200,000 line. So for this tax year, that would actually reduce the amounts that can go into a pension on your behalf to £15,000. That's also the same for 17-18, 16-17, but you can see it's actually different in the 15-16 column. So one of the reasons we're having this webinar now is that in exactly a month's time, on the 5th of April, that 2015-16 tax year will fall off the conveyor belt and you will lose that allowance. And it's also worth mentioning that in that year there was a nuance of rule changes whereby you could potentially split the tax year depending on when your pension started, and for some people it could actually be £80,000 that will fall off that conveyor belt. So if you're looking to backdate pension contributions either personally or through your company, then certainly this month is a really, really crucial month to look at to receive all that lovely tax relief. Now, we had a look at children's ISAs. It would be a shame to miss them out on the pensions as well. So this is something, again, which a lot of GUNNERCOOKE partners are now considering, is that you can actually set up a pension on behalf of children. And this is from when they're newborn babies all the way up until they are 18. Now, the vast majority of children don't earn any money, and therefore the maximum contribution that could go into a pension in their name is $2,880 in terms of how much it would cost to put the money in, and HMRC tops that up to £3,600 thanks to tax relief. So to ask, I suppose on this environment and on a webinar, it's going to be a rhetorical question, but let's say there was a new baby in your family, and you wanted to make those contributions every single year for the 2,880 topping up to 3,600, and you wanted to make that contribution every single year up until when the child was 18, and then you stopped. And you never made any further, nor the child made any further contributions to that pension all the way up until the age of 65. So how much money would be in that pension when that child reaches the age of 65? Now, to give you a little clue, it will have cost you broadly about £52,000, and the government would have topped that up to £65,000. The answer is on the left-hand column on the screen. So it's actually a staggering £1,120,000. I'm not going to read the small print down on the bottom, but I'll let you read that at your leisure. But that is essentially the effect of compound returns, compound interest. I'm sat in a room with a picture of Albert Einstein, and I think it was one of his quotes that said that compound interest is the 8th wonder of the world, and there it is for everybody to see. Now, if you just made that contribution, let's say you thought it was a fantastic idea, but your child or maybe grandchild is age 5, then you can see that it's still quite a worthwhile way of contributing, because even then the amount actually rises to £703,000. So, just to summarise in terms of the pension contributions, the pension contributions attract tax relief. Now, if that's your company, fantastic way of making pension contributions, tax relief at 19%. If you want to make that personally, then obviously it's basic, a higher or additional rate relief as well. The government does control how much it pays out in tax relief. Has slightly gone off the agenda really because of Brexit, but we don't know exactly when that's going to come back in and these rules are going to change. But obviously at the moment these are what the rules are. Pensions are generally outside of your estate for inheritance tax purposes. So actually we're more and more finding GUNNERCOOKE partners who are going to start using pensions as a way of actually saving on inheritance tax, because if certainly if you pass away before the age of 75, I'm not saying that's a life plan, but if that happened, then a pension that wanders down the generations to children and grandchildren means that they will actually able to take that money out completely free of tax. And whilst it's in the pension, it still enjoys all of the tax advantages that you and I do for money in your pensions now. If you pass away after the age of 75, it's still outside the estate for inheritance tax, so it's still saving that 40% relief. It's just that they would pay income tax, the children and grandchildren, on the money that were coming out of the pension. So that's all from us. Obviously, there might be quite a few questions there, but please don't hesitate to get in touch if there's something that on this webinar that you want to discuss. I'm now going to pass you back to Liam, because quite often our GUNNERCOOKE partners are asking us about the state of the investment markets right now, and I think it's only right just to cover that off as well. So here's Liam.
Thank you very much, Richard. So yeah, looking at the screen just there, it would be fair to say we are in uncertain times. There's all sorts going on. We've got Mr. Kim Jong-un, we've got Trump and Putin, we've got the powerhouse of the economy that is China. And you know, these are all genuine concerns that people do have. And you know, how does this affect my investments? We've got Brexit, the impending sort of departure from the EU, and you know, how is that going to affect our markets? I think the truthful answer is, though, you know, although we are in uncertain times, there has always been uncertainty in markets, but it always has been the right thing to do over the longer term for an investment purpose. When we talk about longer term, we always consider 5 years or more as long term. But what you'll be able to see from the graph just here is, you know, going back to 1986, so 30 years ago, there's been a number of events that, you know, we've all thought the world was going to end, you know, maybe 10, 15 times. However, it hasn't, and markets have gone on and they've actually returned really well. And what you can see from this graph is what return would you get from your investments if you invested £100,000 back in 1986 in different assets. And the different coloured lines, so we've got the darker coloured blue line, which is the equity, so it's the FTSE All Share Index. Then we've got the kind of paler blue line, which is property markets. We've got the black line, which is bonds, cash, and inflation on there as well. So what you can see is, you know, despite all the events that we've seen over the last 30 years, if £100,000 was invested in the FTSE 100 index, sorry, the FTSE All Share, back in 1986, it would actually be worth in the region of around about £1.4 million today. Obviously, along that 30-year period, we have had peaks and troughs with markets. Like I said before, it's all about, you know, having a long-term kind of aspiration. And when we're kind of dealing with, you know, the partners within GUNNERCOOKE, you know, a lot of it's regarding planning for retirement, planning for an age where, you know, kids are going to university. This is generally a term of 5 years or more, which is a good period of time to get your investments working for you. One of the most concerning kind of figures on this graph for me is, you know, the inflation rate. You can see in 2017 it was 4.1, which was high. You know, last year it was 2.7. And if people, you know, our clients are holding a lot of money in cash, the impact that has is you're actually losing money, you know, to the tune of around about 2% a year. So it's all about thinking about risk, how much risk you're actually willing to accept, and, you know, accept a managed level of risk just to try and get real returns over the longer period, because you certainly need to be getting a return in excess of inflation to get real growth in your money. So how do we manage risk? And this is one of my favourite charts, really, because it just shows the unpredictability of markets and where to actually invest your money. And what it shows is the last 5 years. So you can see 2014, 15, 16, 17 and 18. And each of those coloured boxes is a separate asset class. So, for example, in 2014, you know, the best place to have your money invested was in US equities. The second best was UK property, all the way down to commodities, which was, you know, potentially the worst place to have your money in 2014. What you can actually see is that graph changes year by year. So it's almost impossible to actually think where to invest your money. So the title of the graph is why diversifying is so important. And one of the things that we do is manage risk and understand the level of risk that our clients are happy accepting. When we manage our investments, we will make sure that within an investment portfolio, you have exposure to all different asset classes. When we have that true diversification within the portfolio, we can always make sure that you will always be invested in the right asset. So whichever asset's performing at a greater level, you will have exposure to that. And that's the only way to manage your investments, diversification. One of the hardest things to do, which is nigh on impossible, is to actually time the market. So trying to manage the peaks and troughs of stock markets and invest when markets are low and sell when when markets are high. Firstly, it's almost a full-time job for anyone to try and do that. But this actually indicates what you would have got back if you missed out, well, the 10 best days in the markets, the 20 best days or the 30 best days over the last 20 years. So if you invested £100,000 in the FTSE All Share Index 20 years ago, the previous chart was 30, you would have stayed fully invested, you've never taken the money out, you'd have £341,744. If you tried to time the market and by chance you missed the 10 best days within the last 20 years, you'd have almost halved your return. So you'd have only received £184,927 back. What can also happen is very often the best days come after the worst days. So if you're trying to time markets, it's very, very difficult. So the way we will always advocate is if you're investing for the longer term, which we'd always suggest is 5 years or more, and what we'll always try and do is, hold your nerve. If, you do become a little bit nervous because your investments have fallen in value, the worst thing to do at that point is actually encash your investments because you are just crystallizing a loss. You've got to have faith in the active fund management behind your investments, that when markets do fall, it actually creates an awful lot of opportunity to buy shares that are good value and will give good growth potential over the longer term. So for that reason, we do actually want volatility in the market because it creates opportunity. Our approach to investment management through Capstone Financial Management is the fact that we will constantly try and understand and select who are the best investment managers all around the globe. Now, there are people that specialise in different geographical locations and in different asset classes. And it's our job with the investment management approach at St. James's Place to actually research who these best managers are, but then monitor those managers to ensure that they are sticking to their mandates. They're taking within the risk levels that we set, and they're actually achieving the sort of returns that we'd expect them to get for their actual asset class. If needs be, we'll then change these managers to make sure we've always got the best people managing the monies for our clients, and it's a consistent and ongoing management approach. So, your tax year end checklist. So if we could list out a number of bullet points and our pearls of wisdom that you should be thinking about before the end of the tax year on the 5th of April. Make use of your ISA allowance. It's £20,000 per person. Has your spouse maximised their allowance between the both of you? That could be £40,000. Your children have also got an ISA allowance, £4,260 per tax year. For those who haven't or would wish to maximise their pension savings, do so. You can carry forward the previous 3 years. If you're a high earner, okay, as soon as you start earning over £100,000, so money you've taken out of your company via salary and dividends is over £100,000, you'll start to lose your personal allowance. What we can do by clever financial planning and by using personal pension contributions is bring your income back down to £100,000 to regain your personal allowance. And there's actually, what we can do is, because you do lose your personal allowance with income over 100,000, in fact the net kind of tax relief you'll get on pension contributions at that level can be around 60%, so it's well worth doing. If you've got assets that are exposed to capital gains and capital gains tax, you do have an allowance which is 11,700, so it might be worthwhile encashing some investments, taking advantage of this allowance to then use tax shelters for that money. You've got an inheritance tax gifting exemption, which is £3,000 for this year. If you're thinking about making a large pension withdrawal, it actually might make sense to do it over 2 tax years. So this current tax year will come to the end on the 5th of April. If you then took a further withdrawal after the 6th of April, you're effectively doubling your allowances. If you own a business, which many of you do, certainly be taking a minimum of £2,000 in dividends, because that's a tax-free amount you can take out of your business. Also, as Richard was discussing, diverting your company's profits into a personal pension is a very, very tax efficient strategy. One of the key ways that directors can reduce the tax on their business and their corporation tax. I'd just like to summarise again some of the exclusive options we have for the partners of GUNNERCOOKE. So we can actually offer you exclusive discounts on private medical insurance. We can get you the best prices on life cover from the market that can actually be paid through your business. We've negotiated a price beater offer with a leading insurance provider to make sure we can do this for you. We've been the financial advisors of choice for GUNNERCOOKE. And it's really important that you are business owners. It's important to understand that, and you are responsible for your own financial destiny, as it were. There isn't a company pension scheme. There's no death in service. These are all areas that we can help you with. And we do have an understanding, having worked with many GUNNERCOOKE partners and spoken to many partners within GUNNERCOOKE now, we've got a real good understanding of the model and how your financial planning priorities will change throughout the career from when you first start out as a partner to growing into a successful and established business, and then actually advising you when you actually come to retire or exit your business. So we understand what the financial needs and how we need to help our clients throughout that life cycle. One of the great tools that we actually have, which many of you probably have now experienced, is actually building a cash flow model. And for me, this is the true way to actually plan out your financial future. So what we can really smartly do using software is understand your current financial situation in terms of assets you have, income that you earn, liabilities that you have, and we can model a cash flow forecast all the way through to your retirement. And with this, what we can actually do is understand what you need to do to have the future that you want and the level of income that you need to be saving now, so you've got enough assets that will provide you with a standard of living throughout your retirement. And I would urge everybody to go through that exercise. It's a real eye-opener, and it can be used if you want to retire early, if you want to have what we'd call a glide path into retirement, i.e. working at a certain level up to the age of 50 or 55, then potentially look to reduce the hours that you're working, and we can subsidise that with your savings and investments, so we can really plan out what you can afford to do as you progress through your career. So that is everything from the webinar today. You can see on the screen there the advisors that are working with the partners in GUNNERCOOKE, myself, Richard, Matthew and Robert. So please do take our details down and obviously contact us if we can help you in any way. What I am going to do now is actually open the questions box just to see if anyone's been leaving any questions, and we can take it from there. Okay, does anybody have any questions? By the sounds of it and by the looks of it, there aren't any questions in the box. So I guess that we've covered all the main points that you potentially wanted to get out of today's webinar. If you have any questions at all, please do feel free to drop us an email or pick up the phone and give us a ring. We'd love to help as many people as possible. What we will be doing following the webinar, because we will know who's managed to log on, we've got an excellent summary of the allowances that you have before the end of the before the end of the tax year. So we'll drop that on an email to you before the end of today. So thank you very much everyone for your time, and it was a pleasure to speak to you all.